afternoon, everyone, and welcome to Stock Market Today. It's Allie Corman, Ed Carson here with a breakdown of the action, not only in today's session, but how the week progressed. And Ed, what are we going to be taking a closer look at today?
Yeah, we're going to take a look at Vertex, Broadcom, and Costco, which are showing relatively good action, but the market overall is not.
Yes, it's exactly right. Okay, well, first, let's take a look at those major indexes and talk about said market action. So here's a look at the NASDAQ composite, which it did finish off of its intraday lows, but still down 1.7%. We also had the S&P 500 down about 0.8% by the end of the day, the Dow down 0.5%, and the Russell 2000 down some 2%. So not what we want to be seeing when we were just a couple of days ago on the cusp of a follow-through day.
On the cusp of follow-through day and right at Thursday's open, we came right back down. I mean, it was right at the 21-day line. All the major indexes did it. We knew that was a possible resistance area, and boy, right away. Now we've fallen really sharply lower, pretty down for the week. Obviously we have a ways to go to get to the February 24th lows. But it's not looking good. And I guess in the intermediate stretch is the 13,000 level. It seems important because that's where that would be undercutting the January 28th low. It would be below the February 23rd low, which was the lowest close. There was a low way back in May. So that in itself would be pretty weak. And, just that's the thing. There's certain sectors that are working, but everything else is not.
Mm-hmm. And let's also now take a look at the S&P 500 as well here, which also hit resistance at its 21-day moving average. The Dow 0 DJIA on MarketSmith as well, also slipping, but above its lows from a couple of days ago. We also have the Russell 2000 we want to take a look at as well. Headed back towards its late February low as well. Still quite a bit of room, but still the trend's definitely lower here, Ed.
Yeah, I mean it's possible we go sideways here. I mean we clearly have no upside momentum right now. Maybe we go sideways, which wouldn't be the worst thing, though there are more stocks that are setting up than there were after late January. Wouldn't be the worst thing if we took some more time. I mean, it's a war. We've got the Fed raising rates in a couple of weeks. So just hanging on wouldn't be so bad. But there's just doesn't seem to be a whole lot of upside. It seems like it could be very tentative too, at the best.
Yeah, and the swings have been pretty wild, and the rallies have been short-lived. So from here, what kind of action would we want to see? We would want to see perhaps lower opens and strong closes, and less volatility as a place to start.
Yeah, I mean, you would like to see the market obviously have a follow through day, but also get above that 21-day line, which clearly is a resistance area. But there's so many other resistance levels, the 50-day line, there's these February highs, the 200-day line, and it's different from different indexes, but all those are there. And on the NASDAQ, you could almost argue we're on our third leg. But for the other indexes, it's definitely, we sort of peaked in early January. So we could easily go down. I mean, we have that third leg, maybe on the downside, maybe we have a third leg down. We'll see. It doesn't have to happen, but you just have to keep that in mind. It's like, oh, I'll hang on and everything will be fine. Well, it may not be. We could go down you could go down a lot worse than this. So that's just, you have to be thinking about capital preservation, keeping your exposure really light.
Yeah, that's right. So even in this rally attempt, investors may have thought, hey, we are on that cusp of a follow through day. Maybe now's the time to dip my toe in the water, but this is exactly why we don't want to get aggressive, even when we do start seeing all of those blue dots and nice setups. And hey, again, if you've been in the right stocks, you're like, what a correction here. But right. But by and large, it's been a tricky market to play.
Yeah, absolutely. It's just been really, really tough.
Okay, well, let's take a look at some group action with ETFs. If you can believe it, energy is continuing to march higher in a strong way, with an exclamation point, I think, on Friday, with the XLE ETF adding another almost 3% in this strong move that's been going on for about 2 months now. And maybe this is the very beginning of a larger move. But where we are now, it seems like for a number of these stocks, not all of them, they seem maybe more in either a profit taking area, or if it is a new buy, go into it knowing that maybe this group could be due for a bit of a rest. What do you think?
Yeah, absolutely. I mean, there are some stocks that are coming out, but some of those are the laggards. These are the ones that didn't break out, even though oil was surging, months ago. I will say this. I mean, XLE, while it had a huge week, I mean, crude oil futures rose 26% this week. I mean, so oil prices could go sideways for a little while, and I don't know, energy stocks might continue rising. There's a lot of momentum, and it's all sorts of commodities. We'll look at some others, but I mean, we're not looking to look at it, but wheat had just went completely skyrocketed. Everything is going up in the commodity space.
Mm-hmm. And now let's take a look at mining, the metals and mining ETF XME. What an eye-popping move here, sparked by the geopolitical action.
And it was tough. They had so many, all these kind of issues where it tried to break out, and it failed. It kept on doing it, and then it finally went. And it came from such a low area. I mean, I passed on this because I just was too gun shy at this point. And I figured, oh, no, we could be a time for a rollover after that big run from 40. No, I mean, this one really moved. So I don't know how much further this goes, but man, what a move.
Mm-hmm. And we were taking a look at a number of the stocks in the group at the beginning of the week as they were clearing, and late last week as they were clearing early entries and starting to break out. Let's also take a look at XLV, the healthcare ETF. So this is starting to get a little bit of momentum in the last week and a half or so.
Yeah, and we're going to take a look at Vertex, but there's a lot of medical stocks that are looking good. I mean, that look better than this, but you could sort of see medicals as sort of a safe haven. I mean, geopolitics probably won't influence it. Economic growth doesn't have a huge impact because people tend to use their healthcare now. I mean, the pandemic was one thing, and that's coming off, but that's just an area that may be relatively insulated from the back and forth. Because one of the concerns for energy and commodities is that, let's say, peace breaks out, you could see massive declines overnight. So this seems like a safer sector. I say that, and then you look what happened in January. So, I mean, just because you can tell a story that it would be stable or that the businesses will be stable doesn't mean the stocks will be stable. So something to watch, but not something to be sure that it's going to work either.
All right, and let's check in on the reopening theme with a look at the Jets ETF. This is not looking good, Ed.
No, and this was a weaker area. Airlines were already troubled. They've got extra trouble with fuel costs, and what are people going to do with all those extra jets that aren't flying anymore? And I mean, so they've got problems beyond the other ones, but this is just an easy way to look. The travel plays, the hotels, the online travel that was doing so well just a few weeks ago really had a tough week. So that's just the way, the war has just completely upended what seemed like was going to be a great story for 2022.
Mm-hmm. And let's also check in on speculative growth, a proxy for that, the ARKK ETF, down 5% on Friday. Man, this looks like it was a good shorting opportunity there in hindsight with that resistance at the 21-day.
Yeah, and you notice how it peaked earlier, and a lot of other stocks that it peaked before the major indexes. That they were moving up and doing things. So this was weak ahead of time. It's just a tough climate. I mean, slowing growth for a lot of these stocks after huge 2020s, rising interest rates. I mean, again, maybe they'll come back, but this whole sector and plenty of stocks that ARK had nothing to do with were selling off too. It's not just that what they were picking. The whole anything with highly valued growth just crushed this week, just crushed pretty much for the past year.
That's right. And even though that in hindsight seemed like a good shorting opportunity, this is an ETF and the underlying stocks that can on a day-to-day basis have big percentage moves. So it seems like at this point, with a couple of days down, we don't know what next week might bring, but something that we discussed on IBD Live this morning, reiterated really, is if you are going to play the short side and the long side too, for the most part, is at least taking those partial profits quickly, but have a short time horizon on the short side, Ed.
Yeah, I think that's always the case with shorts. Yeah, because this one could go up 10% on Monday. I mean, it could easily just, with not even a tremendous day for the major indexes. So yeah, things like this, huge potential gains on the short side, but massive short covering issues too.
Hmm. Well, let's take a look at a standout in the medical sector that we've been tracking for some time now with its strong move that started in mid to late November, and that is Vertex Pharmaceuticals, VRTX. So it had this powerful move and a pretty orderly pullback to the 50-day line. This week saw a rebound off of that level, and it did manage to get some above average volume by the end of the day on Friday.
Yeah, this is still pretty close to the 50-day line, I think. The relative strength line is at a new high, or at least the highest, I think 52 weeks. It's basically right around 52 weeks on a weekly chart, and it won't show up for another hour or two, but I believe this will have a flat base. There's, count because that's a down week, so it counts. So 1, 2, 3, 4, 5. So this is an early entry in a flat base. It's almost like a handle on that giant base. It's too low for that, but it's sort of, you can sort of see that gigantic consolidation. So yeah, so nice action there. Growth is supposed to slow as they're still looking to try to get out of the cystic fibrosis area, which is still a huge cash cow and is still growing for them. But they're looking into other areas. This was our stock of the day. Allison Gatlin has written about Vertex a lot, and she has always great things to say about the company, not just great things to say about the company, but great things you can learn about the company. So I would definitely suggest people read that today.
And this is going to be the first base identified by pattern recognition after this long time off for the stock. But we now have the 50-day back above the 200-day, 10-week above the 40-week on this weekly chart here. And it's just about 2.8% above that 10-week line. And Ed, the PE here is pretty good. So this is more of a growthy name, but its valuation is in line with what Wall Street is rewarding right now.
Yeah, it's clearly, obviously, we normally look at PE ratios, but over the last couple of months, this market has valued lower ones, and this one is in a pretty good spot.
Okay, well, let's check in on the chip sector with AVGO, and that is Broadcom, up about 3% by the end of the day. Some nice volume accompanying an earnings report that showed slightly accelerating growth on both the top and bottom lines. So maybe Broadcom is trying to set up here as it vies to get above not only that 50-day line, but that round number at 600.
Yeah, and the growth is supposed to pick up again, at least on the revenue side for the current quarter. So that was optimistic. The PE is almost exactly the same as Vertex, 19 instead of 18. So yeah, it needs to get above the 50-day line. I suppose there was that mid-February peak that, yeah, you could argue is an early entry. That's well over halfway into the base too. So there's that as an early entry potentially. Obviously, the all-time high is a long way away. Look, it's tough. I mean, if this market struggles, if we go to new lows, this one's probably not going to do well. Vertex probably isn't going to do well, but you would really feel difficult with a chip maker. But it's holding on. This is when you put on your watch list. Don't necessarily jump in on and try to buy, especially right now. Don't anticipate. Don't cheat ahead of an early entry in a market correction. That is just way too many levels of maybes to deal with right now.
Yes. And also, I mean, it really bucked the group trend today, it seemed like, because some of the leaders that we had been focusing on, like RMBS, um, came off of its lows, but fell in above average volume today. Same with AOSL, had a really hard hit today. This is in the same group, and then in a related group, we had Micron MU taking a big hit today. So I guess on the one hand, it's good that Broadcom withstood that, but also not great to see a number of its group peers and just related stocks taking big hits today.
Yeah, there's real trouble with the chips. I mean, just everything was hard hit. We looked at ARC, but the chip stocks, which have modest to strong PEs, but usually not that triple digit or no digit PEs, still really hard hit. Yeah, so that is definitely a concern. Whereas Vertex, there's some other names and the whole broader medical sector, there's reasons to be optimistic. Yeah, there's there are reasons to be concerned. You need a stronger market for sure, I think, with Broadcom.
Let's take a look at Costco, which reported earnings this week. Some nice support at its recently retaken 50-day line. So dipped a little bit on Friday, but arguably a good thing after so many up days in a row, especially one that came in some pretty heavy volume after the earnings report yesterday.
Yeah, so that was nice. And held the 50-day line. So that was positive when you can put it in the context of the 6-day winning streak. Losing 1% on a day like today, that sounds fine. So I think if it got above Thursday's high, you could probably argue that's an early entry. It's a somewhat defensive name. I am a little concerned about the PE ratio, which is getting a little high for, it seems like for Costco, that just seems like it's getting up there. Because its growth is solid and it's strong, but you don't anticipate like, oh, maybe it could grow 50%. Well, probably not, but nonetheless, this is doing better than most retailers, and most stocks is showing good technical action.
And Ed, I guess the problem with the market correction now is we are seeing a lot more base patterns that look more or less kind of sort of like this versus setups where you have that strong prior uptrend and then it drifts back into a moving average and then strongly rebounds off of that level. What do you think about that in terms of just the kind of setups that we're seeing right now, whether it's cup with handles, these double bottoms with stocks trying to get above a 50-day line versus pulling back into a 50-day line that they've been above?
Yeah, well, this is what relative strength looks like nowadays. I mean, well, there's relative strength like the oil companies or something like that have just gone to the moon, but anything that's reasonably close to a buy point, this is what they're tend to be doing, is struggling to do that. And I mean, that's one reason we like clean looking bases. I mean, part of the reason is that's probably means it's got a nice calm market. You have that prior uptrend, you have those things. So just looking at this chart and looking at this relative strength, if you're really thinking about it, you'd go, yeah, the market's not doing so well, is it? I mean, you can look at that and not know anything, but just know that the RS line is hitting a new high, even though the stock is like 10% or 8% off the pivot. So yeah, I mean, this is what you need the market to strengthen. If this market strengthens, all this relative strength, and yeah, the charts may look messy, they may work out fine, but it is a bad market. It's just good enough to trick you to come in, and then wallop you. So definitely be careful.
Yes, we want to be careful in this environment. There's that added risk element. We don't have the follow through day yet. And even if we do, that's not our golden ticket to start rushing in again, Ed.
Can't really rush in when there's so much Russia news going on, I would say. Look, there's nothing wrong with being in cash or almost entirely in cash. If you do go in, keep your exposure light, keep them in the sectors that are working for the most part, and have a shorter time horizon. I think, like taking at least partial profits at 10% or even 5% if you really, feel like it, just get something in there to make sure you can get out with a win or a break even if something really turns on you. Ultimately, this is probably not the time when even if you're successful, this is probably not going to be the best time of the year for you. So, I mean, don't put that much effort into making money now. Just be focusing on building those watch lists. A lot of it's like a sandcastle. The tide comes in and washes them out. You have to build the sandcastle again. Keep building those sandcastles. Eventually, it'll really become a sandcastle. It's something that becomes real when we have a real follow through, and then you'll have that. You'll be ready to go. With a real, I mean, not just a follow through, but real strength. You'll be ready to go. But that's just the kind of market we're in right now.
Yeah. And what do you say to investors who are getting chopped up right now and are feeling out of sync with the market? And they're seeing these stocks and these certain industry groups that are doing really well, but they're not seeing the same kind of progress in their portfolios.
Well, they should just probably be getting out of their portfolios. If they're in the areas that are not working, they should be just stepping away. I mean, if you're out of sync, you just have to take that as a lesson. Even if you don't know what else is going on, I'm losing money. I should stop what I'm doing. I mean, that should be something. And you can look for things, but don't be chasing into those sectors. Don't go rushing into these stocks like some of those sectors that have been going vertical. Well, they might be, as you were saying, ripe for a pullback. You just wait for good opportunities. Your time will come. It doesn't have to be right now. The time may not be now.
But it could be around the corner, so we gotta stay sharp. And yeah, if you're out of sync, maybe do some post analysis of your recent trades and wait for better conditions because we'll eventually come out of this period. All right, thank you, Ed, and thanks to everyone for tuning in. We will be back with more on Monday, so make sure you're going to investors.com/IBD live in the morning. And in the meantime, investors.com is the place to find all the latest stock market news and analysis. We'll see you next week.